Morten, can we just dive into one of the hottest topics in the Norwegian media right now, the plans ahead for Hunter Group? And maybe before you share the vision for the company ahead, can you also just tell a bit about the history? Because there is a previous chapter in Hunter that I guess is relevant to know about for new investors as well. So can you just paint a picture why Hunter now and the plans ahead?
So Hunter Group has been, the history is that first it was an oil service company, which is many years ago. And then in 2018, Arne Fredli became the main shareholder in the company and also took in 8 VLCCs. So the company the current team has been involved with building VLCCs, getting them delivered on charter and selling VLCCs. Then all the vessels were sold, and at the moment, last 1 year ago, it was only a shell company basically, but it still had the 3 key people in there. One person who is very capable on the technical side, with 40 years experience in that field, and then a CEO and a CFO who's been through these procedures with chartering out vessels. So then 1 year ago, I came in as the chairman. It was basically nothing in the company other than the people and a CO2 tanker project, which is very exciting, but it can take many, many years before actually CO2 transport will become a viable business plan. So that idea is kind of sleeping. The concept is ready, but we need a long-term contract to build a ship. And if we are the front runner on that, on CO2 transport, it probably could be quite easy to multiply that and build more ships if you have contracts in the other end. Nobody will want to build something like this without having a contract. If they have private money, you need to have the rest of the value chain intact.
I see. So from the part you got involved, how many months have you worked with the strategy you're putting forward today that is quite, newsworthy?
We believe a lot in the VLCC market, the very large crude carrier market for the next 3 to 4 to 5 years. From that time, I think we think it's a big chance that the market will be overbuilt, so the market will fall again. So this summer we're looking at the old vessels that didn't have too many years left to be able to capture this kind of 3 to 5 year window. And then this autumn the management came up with something I think is a lot better, which is using the relationships the company already has, using the contract sort of templates that they already have with major players in the shipping industry, and just take a position on a fixed price in and simply just charter out spot to the same trading company. So what is this really then? Well, it's a pure play on the eco VLCC market with scrubber. The next 3 years, I would say with an immense leverage, because it's hired in on a price that's below the 20-year average for these kind of ships, below what you would need if you wanted to build a new ship in the lifetime of the ship. But you only have this exposure for 3 years. And that means that if the market goes bananas over the next 3 years, we will capture that. If the ship has a technical problem, it's not really a big problem for Hunter, because we don't carry that. We hire in and we hire out. So it's not really our problem. It's the price we get is just simply a quite complicated calculation of an index.
Can you explain a bit the risk profile then? Because why invest in this adventure versus, established tanker companies positioned in this cycle? Is it just like a high risk, high reward game, or do you also want to balance the downside? Or is that hard to do in this case?
I would say it's a very much a high risk, high reward game. So when I look at the investment I have in Hunter, I could at least multiply that by 4 if you look at the exposure we actually get. And that's where the fun starts. So it's with the little money, you get a lot of potential upside, and the downside is definitely 100%. But I would say on the risk reward basis, I mean, you have to think of it as buying a ship with kind of at least 95% leverage, owning it for 3 years and then selling it. But you don't have to deal with buying and selling the ship. It's kind of you just own the surplus or deficit income on that ship for the next 3 years. So meaning that if you have rates if the rates reaches the analysts' consensus estimates for the next 3 years, then we are netting north of on the 2 ships we have today, and north of $60,000 per day, and that is a couple of $1 million per month, and the company market cap is just north of $20 million. So this is what I find quite attractive, that actually on the consensus estimates of the analysts, you get almost 10% return per month on the 2 ships we have today, and we are able also to take in at least 1 more ship with the current balance sheet.
Can you explain a bit your thought process behind this market we're entering? Because of course there's a huge sentiment and it looks good for many different reasons, but the fascinating thing with this market is how easily it can shift through geopolitics, big nations, OPEC, etc. How do you build this analysis in your head, and where do you also calculate worst case scenario, and what is the worst case scenario from the market perspective on the rates, etc.?
First of all, I think I'll start with the reason why we invested like this, and the reason why I put my own money on it, and that's kind of first of all, I mean, it's a risk. I see it as a big risk that the oil price can fall quite significantly during the next year or 2. And the reason is that Saudi Arabia has taken basically responsibility for almost all production cuts, while the US production has exploded in the same period. This is not a lasting situation, I think. So within the next few years, it's a big chance that Saudi will produce more oil at the expense of the rest of the world. And the more oil you get from the Middle East, the longer the distances and the higher the rates. That's one thing. And also the lower the price of oil, the bigger chance there is that it will be a contango in the prices. So the prices forward in time is higher than the price now. Reason being that it takes time to shut down production. It takes also time to ramp it up. And therefore, I mean, a bull case scenario is that Saudi just pumps out a few million barrels extra per day. The oil price plummets, you get a contango, and you get a big chunk of oil being stored on ships. So that's sort of a bull case scenario, sort of just on the situation, on the oil market situation. Then you have another, I would say, scenario with the geopolitical risk that there is a history in tankers that the more geopolitical risk, the more expensive it becomes to transport oil. At the moment, with the situation in the Red Sea, that doesn't seem to end anytime soon. Or if it ended tomorrow, you would have still logistical issues for the next months to come. And it's quite easy. I mean, if you fill a Suezmax takes about 1 million barrels. You can take it through the Red Sea and through the Suez and up to the markets there. Well, if you can't go through the Suez, why not put on 2 million barrels in a VLCC and go around Cape Good Hope? So the difference between the Suezmax rates and the VLCC rates is just should be higher, should be than it has been the last few months because of this. So that's sort of the short-term kind of upside, and then you also have a record low order book. I mean, you always have to look at how many ships are on water, how many ships are in the yard. At the moment, there are very few ships in the yard, so it's a visibility that the next 3 years, it's almost impossible to build the market to pieces. This is why I feel we found the sweet spot, a very interesting sweet spot, and now it's just to try and milk that sweet spot as much as possible. And hopefully we can have a few more ships on so that it will be a more liquid ETF that we are creating. But I think that's realistic. But it has to come in at the time when we're able to do a good deal, because at the moment it might not be possible to do it at the price we want to do it on, because it's very important that it is on a correct price, because you do not want it becomes very expensive if you get too bullish when you have some kind of geopolitical situation, and then next month the problem is solved and markets are and the oil demand is going down, Saudi is cutting a bit, continuing to cut, and then it's not as fun. So and now you're on to the downside. I mean, the rate we have taken the ships in on is roughly on a traditional ship that would be $35,000 roughly, and you can add $17,000 on eco scrubber fitted ship. That brings us to sort of roughly 52,000. And yes, I mean, the tanker rates can be much lower than that. So yes, there is a risk.
There's always a risk associated. So, but to summarize what you're saying, this is also precision work ahead, because you don't want to make the wrong deal at this stage, because then it's going to be very hard to course correct. So this is a short timeline we're talking about here.
Yeah, and I think sort of it's also a very important hedge to me, because on the other side I have oil service exposure. And it's a kind of falling oil price. It wouldn't be a big crisis for my oil service, or for the oil service companies' revenues, because they have long contracts, but it won't look good. So then it's good to have a company that makes more money if the oil price falls as well.
Let's make the transition to oil service then, because we wanted to discuss that topic a bit today. Can you just paint the overall picture on the oil service industry, and maybe also add the offshore industry, because it's getting quite a big industry with the renewables adding up as well. But of course, you know, it's a different sector, but still maybe they are in the same supply chains a bit.
Exactly. I mean, you have, when you look at the oil service value chain, you have some parts sort of basically this market hasn't really been supplied with new vessels and new equipment for the last 10 years. You have had completion of equipment that was ordered before 2014, but not much new ordered the last 10 years. And this is obviously an opportunity, but then things have happened to different parts of the value chain over the last 10 years too. I mean, the companies are working much more efficient now than they did before. The drilling programs are much more just in time than they were before. So it is not evident that you need as much equipment now as you did then to produce the same oil. And then what we see is that it takes sort of, if you start with seismic. There, the problem is that you have fewer customers now than you had before. And it seems like, yeah, they definitely need less seismic than they did before of some reason. And it seems to be too much spare capacity for now. It will probably come at some point, but at the moment it looks a bit stretched. Then you go to the rig industry, and what we do know is that it's very expensive to have a rig stacked. That's a nightmare to have a rig stacked. So that's sort of the issue there now, is that many drilling companies sees that it takes longer than they thought to get the utilization that gives them the possibility to reactivate rigs, and also to just get the utilization they need to make money over time, because it's very expensive to have a rig idle. So that part of the oil service sort of time value chain, I'm not super bullish on right now. I think it will come at some point. It will come, and you also need drilling rigs to drill CO2 wells. So in the future, in the 30s, probably you will be using oil rigs to create CO2 wells, which is quite interesting. Then when you come to everything that floats, sort of the subsea vessels, the supply vessels, and so forth, you can see now, and latest today, DOF Group got a contract to fix a cable from a wind farm in southern North Sea. Here it's a pressure from the wind industry and from the oil service industry. Fantastic. And also you still have a market where nothing has been built for a long time. What they say themselves, the companies, have been sort of that, okay, but the renewable industries are not really, it's not really important for us because the oil and gas sector pays a lot more. On the other side, I would call it a really nice stop loss to have these renewable companies ready to take spare capacity. So this is where I have put really my chips on the table. Then you have the FPSO part where you pump up the oil. It also looks good, but also there it's a lot of expensive refits, and it's not so easy. So again, if you look at this value chain, I mean, the floating vessels that I just talked about is where I find the best risk reward, of two reasons. One is they can work for renewables and conventional, and secondly, it's not so expensive to have many of these vessels in an idle as it is with an oil rig, for example.
That makes sense. What are the biggest, if you have decided on that topic, what are then, a couple of red flags that investors should be careful about? Is it, the depth as well and the leveraging part? Because obviously you have worked a lot with high yield, so you know how a balance sheet can turn into trouble in the future. Is that also something you have to be very careful on the oil service industry, how the balance sheet looks? Or if the market is fine, you will be fine regardless?
I mean, in this sector, it's very little debt right now, but there are some, you want to have debt when the tide is going up. So this is, and I would say the sweet spot here. I mean, DOF Group, where I've been part of a restructuring committee for many years, and sort of really know the bits and pieces in the company. I think it's a great company. It was just over-levered. And now they have, for the next couple of years, they pay only 6% all in for their dollar debt. I mean, their competitors would have to pay 10% for the same amount of debt if they at all get a leverage of 60% LTV as they have today, which means that sort of you get an extra 8% IRR on your equity just because you have cheaper leverage, and then on top of that, it's fantastic for the equity holders to own an equity where every new contract is giving explosively higher income, and also long income, not only next year, is sort of like many years. And one can say a lot about Brazil, for example, where it takes time to get the contract in place in Brazil. But when you have the contract in place, Petrobras, they pay on time. there are huge opportunities in Brazil for Norwegian linked shipping companies at the moment. So basically, yes. So this is kind of what you want to look for in this sector is, okay, you see, okay, where you want to be in the value chain, and you find that area, and then you start to drill down, okay, where can I get most bang for the bucks? Basically, they have zero covenants, almost, or not zero, but they have very little covenants for the next couple of years. Very cheap debt, a nice loan to value. Okay, so $1 in DOF is the same as $2.50 in a oil service company without debt. And the tide is rising.
How root of awakening do you see it will be in offshore wind coming soon? Because it's been a lot of talk, a lot of hype, but years are going fast, So how do you, I know you have some quotes about it, but offshore wind, what's your 2 cents on that project? Maybe from a Norwegian perspective, and maybe also from a European perspective.
I think what's interesting is that if you listen to many politicians, when they say sort of, yes, the wind price is on par with other conventional sources, they forget maybe 2 things. One is that when it blows, the price of electricity is low. So the wind, the electricity produced from wind is the one with the least value, basically. And secondly, the interest rates. I mean, all these calculations are done, and all the nice folders are done with zero interest rates. And now we have 4 or 5%. So it just doesn't work, because they have a huge cost when they construct, and then they have 20-year cash flow, for example, to pay for it. And obviously, it's extremely interest rate sensitive. And when you look at the other side on, for example, DOF, where you can pay down the total enterprise value in probably in 4 years, the interest rate means a lot less. And on top of that, I mean, they only pay 6%, which on a 5.5% interest rate in the US at the moment. So that's quite good.
Do you just maybe that was the narrative after COP, that this gap that we have to fill is just going to be filled with nuclear, or do you see anything else on technology that makes you curious about what is the potential for scaling renewables fast?
I think it's super important that the world invests in nuclear everywhere where it's possible, because that's the only real alternative. I mean, you have if you look at Norway as a country, they say yes, but we can produce a lot of electricity to supply our 5 million people in Norway. But there are 500 million people in Europe and 1.4 billion Indians, and you need to have a solution that actually work for the 8 billion people and not the 5 million up in Norway. So I think I mean, I see that it could make sense with wind farms many places, but if you were to fill the energy demand with wind farms, I mean, you would have to have windmills everywhere in Europe almost, and it will destroy nature in a way that we don't want. So therefore, I think nuclear, even though it's expensive, even though it's there's a lot of construction risk, is something that all countries needs to think thoroughly about if they want to have a stable, non-fossil energy source.
Makes sense. Just one topic on shipping that I also want to cover a bit is, your journey with Gram car carriers, because you were very active in that journey for the last couple of years, and it has gone very successfully. Can you just explain a bit about that particular segment? Because that's more like a niche segment in the shipping industry, but also a very exciting mega trend with China, EVs and car, etc. How would you summarize that journey for yourself, and also maybe what's ahead, do you feel?
Oh, and when Gram was listed, it was quite levered, which I like. The tide was going up, and it sort of, the IPO was kind of the last piece they needed to get things in order. So I found that very, very interesting. And basically also there, because of many years of a low market, nothing had really been built for a long time. And then China started to export EVs, and they started on zero basically, and now they're at 5.5 million cars per year. You have 700 car carriers around in the world, and it's even though we have a lot of ships on order now, which that has come in every shipping upturn, you get a lot of ordering. And the question is on car carriers, sort of, is this time different? And I think yes, that now we have a golden age for car carriers because of the Chinese situation. I think it can last a bit longer than many people think because, first of all, China's ambitions are huge, but there are also ambitions in Japan and in Korea. And all of these places have long transport distances. So you get, with a fall in, even though you have a fall in car sales, you could have a quite nice increase in ton mileage going forward. And then you have an interesting situation in that at the moment you have a lot of cars going on containers. Yes, it's possible to transport everything by container, but it's not ideal for the car industry. And it's both more expensive to travel with used containers, and it's you get more problems with the cars. They get scratches, they get smelly. It's not ideal, and they come into ports that not used to take in cars, and it's just not ideal. So you have, at the moment, it's a bit difficult to quantify, but probably at least 50 to 100 car carriers in deficit in today's market. And the Chinese exports are increasing fast. And it's like, okay, if you have a recession, what would you do in Europe? Would you buy a cheap Chinese-built car, or will you buy an expensive European-built car? I mean, probably you will buy the Chinese car. And you also have to remember that a lot of the European and the US car manufacturers, they manufacture cars in Asia as well. So Graham is, for example, transporting Buick from China into Los Angeles, made in America for Americans. But okay, it actually comes from China. So this is why I think we're into mega trend on car carriers. I think the golden age will be at least through 2026, and then probably the market will be more balanced. And again, more balance in shipping often means that the risk of falling rates is higher.
How do you piece together higher interest rates, inflation that is a bit hard to predict, onshoring, war economy? Is this going to be a very interesting time ahead to see how the inflation and interest rates will go? Because it's from my perspective, it seems like maybe harder to predict than people expect, because I feel the narrative is that they're going to drop quite soon and then let's see. But I'm not so sure that it's that easy with inflation, given the geopolitics, onshoring, and all the initiatives from big countries like US, etc.
If you look back in 2008, Lehman Brothers was crushed. And this the Fed doesn't want to happen again. I think that's quite clear. So what they did last year, when you had all the problems with Silicon Valley Bank and other regional banks, they just poured money into the system. So they had used the brakes at the same time as they went full speed forward. And this obviously keeps inflation up. It does. And another thing that is easy to forget is sort of that, especially when you sit in Norway, is that in Norway and Sweden, people feel the interest rates immediately because they are floating interest rates. In Denmark, you had a situation where a lot of people went from 30-year fixed to 5-year fixed, and then they could pay back a lot of the loan through that. So in Denmark, kind of, you haven't really seen the effects of the rising interest rates because people have actually made a profit from it in many cases. And down in Europe, rest of Europe and Switzerland, people have fixed interest rates, and in the US as well. So it's kind of the new builds and the first-time buyers that are exposed towards interest rates, and at some point in time they will feel it for real, yes, but it takes time. And so this is what makes it a bit tricky. I think you have this, as you say, this war economy, the liquidity is poured in, people are having jobs, they get paid a bit more every year, and when you look at it, a lot of homes at the moment is quite affordable as well for people who receive normal salaries, because yes, you kind of they have always just been borrowing 5 times income, for example, and they do that now as well. And so the banks since 2008 have sort of put into their equation that you can't borrow more than 5 times your income, for example. And so if the interest rate is 5 or 3, it takes a lot of time before it actually really tightens the economies, except for Norway and Sweden.
So how do you feel it's going to play out? What are the signals you look for the most yourself when you're trying to, you know, map out the scenarios? And you maybe also will be an interesting year with US election as well. Seems like that's going to be a very interesting election.
So I think it's quite clear that the US, I mean, if you look at their state finances, it doesn't really make sense at all. But in an election year, I think we'll be fine. They will save the consumer. And this is kind of part of the issue in many other places than the US, that a lot more politicians than before are just pouring money into the economy. And so that will in turn create inflation, but at the same time, higher inflation is and higher interest rates are biting into many companies. And if you look at the high yield market, for example, in the States, I mean, you have a lot of companies that are cash flow negative, especially if they when they refinance. And this is where it's going to be exciting, and at some point the market will break, but it's just taking more time than the average Norwegian analyst would predict, because of this floating fixed interest rate scenario.
That's a good point. If you just want to, it's hard to give specific advice to people, but is it time to reconsider, you know, having everything in index funds and putting some chips on the high yield market? Because it's been, you know, for many years that didn't seem like a very attractive place to be, but I know you worked in that field for so many years. How has that momentum changed now, and what's like the guiding principle to use when putting money into the high yield market that now looks very attractive for the first time in a long time?
Also, I mean, it's important when you look at if you look at the high yield space, at least how I look at it, you have 5 different risks that you have to think about, and 2 of them you don't get paid to take. One of those risks is client concentration in a high yield fund. You don't want to be in a fund where one big decision maker can make a lot of trouble. So we've spent the last 10 years to try and sort of diversify our client base as much as possible, also geographically. So now we have other clients spread all over Europe, and we have also different types of customers. So it's a bit like a bank. You don't want all the clients to take the money in one day. The bank will go bankrupt. And then it's another one, which is hedging capital call risk, which is kind of a bit tricky as well, because every high yield fund out there, they say that of course they don't take FX risk, but the risk many of them take is the hedging capital call risk, because when they buy a bond in, for example, US dollars, if they're Norwegian kroner denominated, and we saw when we went into the pandemic, the dollar went up 50% or something like that in 10 days. And then you get a capital call of 50% of that investment. At the same time, the liquidity in the same investment is maybe quite low. So this we solved with having, we've also worked very hard over 10 years having clients from basically in different currencies as well, so that we kind of net don't really have a big currency risk in the portfolio. So then you go over to the three risks that you get paid for, and is the most important is the corporate risk. And that's where sort of the Nordic market is quite special. I mean, we have an ICR, an interest coverage ratio of it's around 5 in the portfolio. That sort of translates into a lot more solid companies rating-wise than sort of the single B that we kind of have. And the reason is that a lot of the companies in Nordics have, especially in the cyclical space, you have a lot of companies with good near-term cash flow, and that good near-term cash flow, they have levered. So it doesn't really matter how the cycle goes, we will get the money back. That's at least what we think. Then it's the duration risk of the interest rate and the duration risk of the bond itself. So you can have a floating bond that's 10 years. If you then have a market crash, the spread will go out and the bond price will go down, even though you might make some money on, that's the case. And then if you have a fixed bond that's 10 years, when the market goes down, you will have the two factors working against each other. One is probably the interest rates will also fall, so that the price of the bond will go up. But on the other hand, the spread will go out and the price of the bond will go down. So, for example, in 2008, you could buy Swedbank hybrids, long hybrids on 40% of par. Then you obviously had some duration issues on the bond in addition to the interest rate changes. So, because the spread went out, and then if you have a long duration, it doesn't look good. So at the moment, we sort of we have increased duration by roughly 1 year from last year in portfolio. It's still quite low, below 2 years, and the duration until maturity is also below 3 years, meaning that we're not really betting on anything else than the corporate risk. And on that, with a historically low corporate risk, we get 8-9% interest rates. It's quite nice. And then I look at it from sort of when you invest in bonds, you need to think about which currency you're invested in. And if you look at the last 15 years, you'll see that, okay, the Norwegian kroner towards the Swiss franc, for example, has weakened on average, is it 2% roughly, more than the interest rate spread within the two countries have sort of indicated. And every time you had the crisis, the Swiss franc went up. So, okay, so if your high yield investment is your insurance, the question is, would you have that insurance in Swiss francs or in Norwegian kroner? It depends sort of which pocket have you, which kind of idea do you have with your money, because it's quite important that it just doesn't go down the drain with everything else when there is a crisis. So when it comes to equities, this currency issue, it doesn't really exist, because you have, if the currency goes down, you usually get paid with the equity, it becomes more worth. So that's why it doesn't really, it's kind of more self-hedged than the hardcore sort of bond debt, which is the company has to pay you back and in that currency that you lent out. So I have a mix now of Swiss francs and a bit Norwegian kroner as well, but mostly Swiss francs. And it's my fire insurance basically.
I think that's the perfect summary. Also, great that it's maybe a bit more complex than people believe because of the currency issue and everything, like you perfectly summarized. So time flies by so fast. So we have some quick fire questions. So I just want to dive straight into them. So can you give us some emerging markets you think people should check out that usually goes out of the radar?
I think actually, well, if you look at the emerging markets at the moment, that kind of is probably most exciting. It's Saudi Arabia and India. There we have 1.4 billion Indians. That's a good start. And Saudi Arabia is kind of opening up with a lot of huge projects. My competence is not investing in that, in those countries directly, but actually the Nordic markets are a derivative of the emerging markets. And the Norway is an emerging market, kind of. We can we go in with the tankers into India and the bulkers and the container ships and whatever there is and the oil rigs. And I think that's a better approach to make money on the foreign market than trying to go dive into it. Because then you have to deal with local jurisdictions that you need to be a specialist on and so forth. So I think on that side, I just try to make it easy and find the derivatives of the emerging markets.
And China too difficult because of politics, or looking increasingly appetizing?
No, I think again the derivative of China is sort of delivering goods to them, building ships there and taking them to the world market. I think again I've become very humble when it comes for emerging markets, and I've seen that political risk very close up through we took care of an investment in Russia for 15 years, and I saw it was a fantastic time, but I also saw that a lot is very difficult to be an expert in a different country with a different culture than our own.
It's very true. So the next one is, what do you feel is the most undervalued listed company? I know that's a difficult one, but your perspective with today's knowledge that could change in tomorrow's landscape.
The most interesting low-valued company today is Wilhelm Wilhelmsen Holding. It's a fantastic setup. They are making tons of money on the roll-on, roll-off car carriers at the moment. And you get sort of roughly, you pay 40 øre for every kroner in there. The company, it's a good thing with the company. It's sort of, it's well run. It's good people employed around, and they have a history of more than 150 years. So it's on the investor relations side, they have to improve, and they have a lot of pressure from the outside on that. And I think in a way there, and we saw already now that they increased in dividends by 80% from last year. And I think it probably will increase more as well going forward, because in order to grow with their subsidiaries without selling below 50% in the subsidiaries, they will not be able to raise equity at a decent price. And this is important for a company that wants to shape the maritime industry. So I think Wilhelmsen long term will probably have a lower discount to NAV in 2 years than they have now. And then DOF that we just touched upon. I mean, that is a levered play in a market that's really taking off. And sort of risk reward wise, I mean, the equity there should double the next couple of years.
Interesting. So next one, we talked about this before, but I'll ask it again. When do you put 1% of your assets in a Bitcoin? Now you have all the ETFs up and running as well. So is it tempting now?
Not at all. And I think the reason is that a currency where you don't know who runs it, kind of, you don't know where it came from, it's just there, and which is very, very good to hide money and to launder money. I think it's probably something that will not exist in 10 years because it's just not possible to control it properly. And China has already I mean, that it's forbidden in China, and I think other jurisdictions will follow.
Okay, that's a hot take. Let's see in 10 years, then maybe have a recap. So 2 books people must read in 2024.
That's a good question. I think for what we do, I mean, that's one is in Norwegian though. But Paul Ringholm, who's, I would say, the leading star in fixed income in Norway, he's written a book on how to become wealthy on debt, rik på gjeld. That's a good one. And then another one that's more again in Norwegian. It's an interesting book if you want to sort of get up and running in the stock market. That's called Aksjeskolen, and also a sort of a way into understanding stocks without having too much background in it. And I think that's a good intro for many.
Yeah.
Otherwise, it's to read the financial news every single day.
I agree. So the last one, I know you love, going on expeditions. So 1 or 2 unique destinations that people should visit. I mean, you've been all over the place almost, but do you have any favorite moments you wish more people could try out? Because I mean, you have a long list, of course, but do you have any particular suggestions?
Up north in Norway is sort of partly where you come from, actually. It's a very nice place. But I think the unique place that's sort of where it becomes more and more difficult to enjoy in the future, that is Svalbard. So I would go to Longyearbyen, Svalbard before it's too late, before the restrictions are too big. So the government is working to make it a lot more difficult than it was to travel around Svalbard, but it's still possible to enjoy it in an acceptable way, I would say. They have 4 months of sunshine, 24 hours, and then 4 months of complete darkness in the year. So it's and all seasons are just as interesting.
Perfect. Morten, thank you so much for taking the time. It was a pleasure to host you once again.
And thank you for inviting me.